Let's take it back to 1956 and 1957 to observe the original formation of the Buffett Partnership Limited, founded by Warren Buffett, which was a vehicle that he used to accumulate much of the wealth that he's went on to achieve, charging typical fees of 2 and 25 and allowing him to initially take an activist role in terms of his investments in companies like Dempster Mill, in which he installed his own management team to add more operational efficiency. Berkshire Hathaway was eventually acquired, allowing the partnership to become more like a holdings company in which Berkshire Hathaway was able to provide the insurance premiums that were critical for him to utilize the capital for future investments. Buffett is typically known for investing in companies like Coca-Cola and Geico, and that's heavily covered by many people in the markets and in the media. But what is not understood is that Buffett is actually very much engaged in entrepreneurial activities, providing seed capital. He also places complex, effectively, bets in derivative markets, bond markets, and is not necessarily a pure stock picker. If you take a look at his portfolio, you'll see that stocks make up only 28% of Berkshire's enterprise value as of 2013, despite being very famous for investing in Coke, American Express, and Moody's. They only account for 8% of the total market cap. So if you take a look at some of Buffett's more famous purchases, you'll notice that they weren't even traditional. For example, they were more distress acquisitions, such as American Express and the deal that he achieved with Goldman Sachs and General Electric in 2008. He effectively demanded a 5-year warrant deal that paid him off quite handsomely. So sometimes when you're thinking about Warren Buffett and his long-term value plays, you need to take a look and understand what is happening in terms of the entity that he has created for himself and the way that he has operated in investing and speculating in some sense on market positions. So I think what would be really interesting to start off what I've already labeled as Value Investing Week was to highlight one of the books that Warren Buffett has declared number one on his reading list on his annual shareholder letter to investors in about 2012, which is called The Outsiders. I've had the luxury of sitting down to speak with the author about this book, some of the concepts in it, and you'll start to even understand that this is not some of the things that are typically spoken about when analyzing Warren Buffett's approach to investing. You're not necessarily talking about companies that are quote unquote cheap, but we're actually talking about things such as economic goodwill, which is extremely undercovered by the press and the media. So I hope you enjoy this new interview, and I hope you can appreciate what we're going to try to deliver for you through the course of this week, which I label as Value Investing Week. So, thank you.
You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
I'm here with Will. Will, why don't you introduce yourself to the audience?
Thanks, Peter. My name is Will Thorndike. I'm a private equity investor by profession, and I'm the author of a recent book called The Outsiders, which looks at eight CEOs with exceptional records and tries to look at patterns across their actions.
Will, you're kind of downplaying this book because actually it's number one on Warren Buffett's recommended reading list in 2012. Could you give us a little bit more of a synopsis on what you looked at in terms of these CEOs?
Sure. Yeah. So, Peter, I think the best analogy for the book is duplicate bridge. Do you play bridge?
No, I don't actually. Tell me about it.
Yeah. So, I'm not a great bridge player, but duplicate bridge is an advanced form of bridge in which a group of teams of two show up in a room, and they're then divided into tables of four, each of which is then dealt the exact same cards in the exact same sequence. So, eliminating the role of luck.
Okay.
And at the end of the evening, the team with the most points wins. So it's designed to be a pretty pure test of skill. Uh-huh. And I would contend that over long periods of time in an industry, it's duplicate bridge. All of the firms in the industry are dealt effectively the same hand. And so if one company materially outperforms the peers, that's worthy of study. And so each of the 8 CEOs in the book fit that pattern. They had to meet 2 tests. They had to have better performance relative to the S&P 500 than Jack Welch had during his tenure at GE. Mm-hmm. That's sort of the absolute test. And then they had to crush their peer group. They had to have meaningfully better performance than their peers. So on average, they outperformed the S&P by 20-fold and their peer group by 7-fold. And so, sort of by definition, in order to have that sort of outperformance, they had to be doing things differently than their peers. But it turned out that the specific actions they were taking were remarkably similar across the group. And so the book centers on that pattern.
That's so interesting because in Asia, there's a game called Go, which is kind of like the Western equivalent to chess, whereas chess pieces, actually, there's different strengths for various different pieces. In Go, which uses basically white chips and black chips, and it's about a game of surrounding, and it's very similar to what you described about in terms of a game of attrition. You're actually trying to surround your opponent in an even playing field with the same number of pieces and just placing them strategically within the board. So that was that's a very interesting analogy that you just provided. I've also seen the same stuff in Moneyball, which Michael Lewis talks about. He talks about competing actually in an unfair market in which, you have teams like the New York Yankees, which, they have a significant a spending budget or a salary cap, for example, whereas, these underdeveloped teams have less of a budget and they have to find innovative ways to compete. So that's a fantastic analogy. In terms of the basically these CEOs, could you mentioned to me about like the criteria of beating the S&P 500, but what were the variables, for example, that made these CEOs exceptional?
Yeah, so there's the pattern tended to center on capital allocation, or I guess I'd more broadly describe it as resource allocation. So most significant piece of that is how a CEO chooses to allocate the firm's profits. So basically, the framework there is for a CEO to be successful in the long term, they have to do 2 things well. They have to optimize the profits of the business they're running. They then have to invest those profits. And that second activity has the somewhat unwieldy name of capital allocation. And over long periods of time, it has a disproportionately large impact on shareholder returns. And so basically, there are only 3 ways that a business can raise capital. They can tap their profitability, they can raise debt, or they can sell equity. And there are only 5 things they can do with it. They can, invest in their existing operations. Mm-hmm. They can buy another company. They can pay down debt. They can repurchase their shares, and they can pay dividends. So that's it. And so over long periods of time, the decisions CEOs make across those 3 sources and those 5 uses of capital have a giant disproportionate impact on long-term results. And this group just made very different decisions in that area than their peers did.
So in terms of these allocations of capital, do you have like a ranking system, for example, based on where the company is in terms of growth? Because obviously there's some companies that are going to be looking for ways that they can stimulate organic growth. There's some mature businesses that are providing, significantly more attractive shareholder yield. So how do you kind of like determine or rank the allocation of capital? Say, for example, on a real-time basis when you're listening to quarterly earnings of companies, and is this more about an assessment on the CEO's capability to think almost like an investor?
Yes. So the short answer is to your question is yes. I think the key is that the CEO be analytical and rigorous in how they think through the various alternatives. And you're right, the attractiveness of those various alternatives will vary with every company's stage of development and growth and situation. So when a company is early on in its development, the opportunity to allocate capital towards internal operations, towards internal growth is likely to be very compelling. As the business matures, that alternative will become less compelling, and other alternatives, like buying other companies or repurchasing their own stock or paying a dividend, will increase in attractiveness, and they all need to be weighed against each other, on sort of a risk-reward basis, and then, the CEO needs to be just rational in how they choose among them.
Based on your study, would you argue that there are different suitable CEOs for a particular company at different phases of the company as well? Or have you found examples where, say, an individual took a startup, was able to grow the business, go into public markets, and successfully maneuver the company throughout the whole history of that company?
Yeah, the short answer is that I think the mindset applies across the various stages in a company's development. And sort of the first CEO that I profiled, the first, the sort of progenitor of the whole book was a guy named Henry Singleton, who built a company called Teledyne from, starting in the early 60s into the 1990s. And he was the founder from the startup phase, and he ran it, through to the into the early 90s, almost 30 years. So I think the most important thing is whether it's a company that is in a rapid growth mode or in a mature or even declining situation, that the CEO be themselves intimately involved in these decisions, and that they be conservative and analytical and rigorous in how they think about them.
And what about, because as you've seen, there's been a lot of famous CEOs. You use this example about like Jack Welch, maybe modern day examples like Steve Jobs, Mark Zuckerberg. Is there a way that, or have you found examples in which a CEO almost effectively acts like almost like a cult of personality and has successfully maneuvered the financials of the company in savvy way? So like when we take a look at Facebook and their acquisition of companies like Instagram for like $1 billion, does this stuff kind of rub you the wrong way from an investment perspective?
I think, in business, I think you have occasional unique geniuses. Mm-hmm. And I think Jobs and Zuckerberg fall into that category. And it's not something that, an ordinary, typical CEO of a public or private company can emulate, the sort of technical or marketing capabilities. I think I'd put Sam Walton and Herb Kelleher in that same category in terms of their marketing expertise. So I think you get occasional unique geniuses who can, create from scratch, large businesses. And I think that's it's just a different situation than most businesses face. And I think, if you look at the capital allocation decisions that those CEOs end up making as their companies mature, if you look at the acquisitions that that Facebook is looking at now, I think now they need to be applying these principles, and often those principles and that mindset are very different than the expertise on the technical and marketing side that built the businesses. So I think it's very hard for technology companies often to make that transition.
Yeah, exactly. Because I get a sense that even if you take the whole genius component, you take the 10,000 hours to achieve significant mastery, it's more about, say, for example, their understanding about information technology. But when you're involved with capital markets, I noticed in that your book, you kind of discuss about the role that the CEO should have in terms of their relationship with the financial officer, how their treasury is being utilized. Could you elaborate more about that role, where it shouldn't just be sheerly strict allocation to that task to a CFO, and where the CEO actually needs to have greater oversight to that to some extent as well?
Yeah, I think it's critical that the CEO not delegate key financial decision-making and analysis to his finance team, to the CFO and the finance team. I think it's important that the CEO themselves be actively involved in that process and have the basic analytical ability to help drive that process.
And is there any instances in which we've seen a CEO successfully maneuver the balance sheet and capital allocation as you still have kind of like a forward marketing cult of personality CEO?
Well, listen, the companies you mentioned have all been extremely successful, and in terms of Apple and Facebook, I mean those are exceptional businesses, and have been well run. Have they optimized the capital allocation part of the piece of the equation? And I'm not intimately familiar with either company, but my guess is they've not fully optimized for that, but they haven't needed to this stage in their development. I think you can look at an even more mature technology business like Microsoft, and you can make the argument that they have missed some capital allocation opportunities over the last 5 to 10 years as they've continued to devote capital to research and development, and have not been as active in looking at repurchasing shares or paying special dividends or other alternatives they might have. Again, I've not studied those situations, but I do think the skill sets are somewhat different, and the situations are somewhat different.
So say you're trying to quantify a screen for some of the aspects you're referring to in terms of capital allocation. What kind of metrics would I be looking at? Is it free cash flow, retained earnings? What would I be considering in terms of a good capital allocator from a financial analysis perspective?
Yeah, well, I think again, I think relative performance is a key marker, right? So if the CEO has been in the seat for more than 5 years, certainly as much as 10 years, I think you can look at the performance of their stock, the per share performance relative to the peer group, and that's I think that's a marker. I think you can look at signals like, have they been significant repurchasers of their stock? What of the acquisitions that they've made, how have they performed relative to the expectations that management laid out at the time of the acquisition? Have they met, exceeded, or fallen short of those? How have they considered special dividends? Are they using leverage? Just sort of looking systematically at these decisions retrospectively. I think you can get a very strong sense for kind of thought process on the part of a CEO and management team. Earlier on, and when a CEO is earlier in their career, I think you have to look to more qualitative signals like sort of metrics and vocabulary, and I think those can actually be quite telling, but they're earlier.
Very interesting. So you mentioned to me offline that you've seen some very interesting examples as of late. Would you be willing to share some of those examples to the audience?
Yeah, no, I think there are a number of companies that are pursuing this sort of approach, these principles currently, public companies, and a list of those would include a company called TransDigm, which is a remarkable business in the aviation components industry. A company called Valiant Pharmaceuticals, I believe, is going to end up qualifying, although the CEO there is still fairly early in their tenure. They've been in the seat about 5 years, but that's a very interesting business, much in the news recently as they tried to take over another pharmaceutical company at the end of last year called Allergan. And then, I think if you look at what the Rails brothers have done at Danaher and more recently at Colfax, there's among the large energy companies, Exxon's record in this area is just extraordinary over a long period of time. There's a reinsurance company called Arch Re that's done an excellent job in this area, a home builder called NVR, a Canadian software company called Constellation Software, and a group of sort of niche insurance businesses that have followed sort of a Berkshire Hathaway type model with very good results over the last 10 to 20 years. A company called Markel and one called Fairfax and one called White Mountains.
Have you had a chance to look at? Sorry, go on.
No, I think that's a pretty good list.
What are your thoughts on Sears Holdings? Have you had a chance to take a look at what Eddie Lambert's doing?
I haven't looked in detail at that. I think what Eddie Lampert did at AutoZone is extraordinary and speaks for itself, and is an excellent example of these principles at work. Sears Holdings I've not followed as closely, and it's just an industry and business that I don't know as well. I think it's interesting. He's pursuing an aggressive strategy there, and it'll be interesting to see how that works out.
Who's the best CEO in your opinion within the last 50 years?
Yeah, that's a tough question.
And why?
So,
that's the key question, right?
Okay. Yeah. So I would say that this year is Buffett's 50th year as in the CEO seat at Berkshire Hathaway, and it's just impossible to ignore the long-term record there. It's truly extraordinary. So he's got to be at the head of the list. I think in that same super elite category, I would put two other CEOs kind of neck and neck with Warren Buffett. One would be John Malone, who has done an extraordinary job over a long period of time, first at TCI and over the last 15 or 16 years at the various Liberty Media entities and diaspora, just extraordinary long-term returns. And then Henry Singleton, who I mentioned before, who's really sort of the pioneer of a lot of these concepts, and just put up an extraordinary record over almost 30 years at Teledyne, the company I mentioned earlier.
Regarding Buffett, I've actually heard some criticism about how he's handled his investment in Coca-Cola, for example, and Coca-Cola not being, having changed their capital allocation strategy. And I've also heard the same criticism towards IBM, for example, if IBM's going out doing a lot of share buybacks, being able to borrow at low interest rates, but where's the growth? So what are your thoughts on some of that criticism?
Yeah, so I can't say that I have intimate familiarity with either company or situation. I think in the case of Coca-Cola, that was a compensation-related criticism. Mm-hmm. And I think, my understanding is that, that Buffett weighed in quite strongly and ended up, what ended up happening there is that the board ended up withdrawing and reconstituting the equity plan there in the face of shareholder concerns. And my understanding is Buffett played a key role in bringing that about. He just did it in a quieter, more offline fashion, which I think is more his style than some of the activists now. Yeah. So, I think they ended up in a place that makes a lot of sense for shareholders there. I think the original proposal was on the aggressive side, okay, from shareholders' perspective, but I think there was a revision there, and I think Buffett was a key catalyst in that, just quietly. As it relates to IBM, I think the jury's still out, honestly. I think it's too early. This is true generally with buybacks. It's really hard to evaluate buyback returns over short periods of time, right? Mm-hmm. If you looked at Henry Singleton has probably the best buyback record of any CEO ever in terms of the amount purchased and the IRRs of those purchases, but at any point in time over the first 3 to 5 years after each of those repurchases, they looked, at different points in time, they looked very poor. So I think you really have to take the long view in evaluating those decisions, and we just don't have enough time. And the short-term results at IBM, I understand have been disappointing, but I think the long-term thesis may very well still be intact there. And if so, allocating capital to buybacks, given the amount of free cash I believe that business generates, could be an excellent decision. I just think it's too early to tell.
But also, Will, who are we to assess, the magnitude of quality of capital allocation? Because you effectively have to think about things like the business cycle, and who knows what the CEO is thinking to some extent relative to what you understand. Say, for example, if people believe that rates are going to be going up in the not too distant future, sometime this year, doesn't that have some kind of impact also? And no one really has that crystal ball, and everyone's just basically, this whole environment of quantitative easing has basically been, everyone just is dancing until the music stops. So what are your thoughts on that?
Yeah. So, in answer to the question, again, I don't think you can have a definitive point of view on the decisions, capital allocation decisions the CEO makes until, a reasonable point into the future, right? Until you see how that plays out. In the interim, all you can do, so you can look retrospectively at decisions the CEO made, and you can have a point of view on how effective, a very clear, data-driven point of view on how effective those decisions were. In the shorter term, I think you have to listen carefully to the logic and decide for yourself whether it resonates and whether it makes sense. And what's interesting is to look for CEOs who are doing things differently than their peers. Taking actions in capital allocation that are different than their peers, and then listen to the rationale and see if it resonates. And occasionally you're going to find situations where a CEO is doing something very different than the peer group. And it might be in the area of buybacks, it might be in the area of acquisitions, it might be in the use of leverage, it might be in dividends, and then understand if the way they're describing that makes sense, and then evaluate over time how that plays out relative to their projections and expectations.
So you mentioned that you also do private equity as well. Is there any difference to assessing outsider CEOs in the private equity space relative to publicly listed companies?
Yeah, it's a good question. So in private equity, the situation is fundamentally different in one important way, which is that typically in private equity, the investor, in my firm, in our case, controls the company. Mm-hmm. And so if the investor in that case isn't happy with the capital allocation decisions, they can replace the CEO. Right, so there isn't. It's just a different dynamic than exists in public companies. Now, that being said, capital allocation is critical, and the private equity investor tends to be much more involved in those decisions than public market investors typically are, mm-hmm. since the partners at the firm are typically on the board, often controlling the board. So there's a closer link there. There's less of an agency risk, so to speak. Mm-hmm. That being said, it remains a critical component of value creation for private equity firms as it is for publicly traded companies. I think the alternatives and the priority vary a bit between private equity backed businesses and public companies. And I can go into that if that's of interest, but I think that's the primary difference is the control by the investors.
Sure. If you could just give us a little dabble on what your thoughts are on that would be great.
Yeah, so I think in private equity, decision making for capital allocation is generally pretty rational. I think where it can fall apart a bit is it can tend to overemphasize debt pay down, it can overemphasize the use of leverage in the acquisition, and then the pay down of debt as a capital allocation alternative going forward. And then secondly, I think often there's an incentive on the part of private equity investors as they approach the time when they may sell the company after they've been in it for 3 or 4 years, when they may choose to underinvest in operations, in internal growth opportunities to optimize near-term cash flows in advance of an exit, right? So, and also in private equity, another difference is it's harder generally to repurchase shares. Often there just aren't other investors who are owners and candidates to buy shares from. Yeah. And secondly, those investors tend to be less likely to sell than the incremental investor in the public market.
One more question. I know we're almost running out of time here, Will, but I got to pick your brain on this one. Is in Asia, a lot of companies, for example, for them to get financing and leverage, they actually usually have to provide hard assets as collateral in order to do so. So many companies, like in China, Vietnam, for example, what they tend to do is they actually tend to allocate and acquire as many hard assets as possible, primarily real estate, for example. And the issue is that, say, for example, it's a fantastic operating business. They're creating garments, for example, and they're buying a whole bunch of real estate in order to get potential financing in the future. It actually, the banking system itself kind of dictates some of the decisions and capital allocation decisions that the CEOs make. And the issue is that when, some of these companies, or if there's like a real estate glut, then boom, all these companies are immediately affected. So how much do you think the, banks play a role in how a CEO is strategically planning out capital allocation?
Yeah, well, I'm not familiar with the Asian situation, and that situation, as you describe it, I mean, that is leading to suboptimal decision making and capital allocation in those companies if they are actively pursuing ownership of real estate assets to attract leverage. That sounds to me as though that's very dangerous and not very rational. I think in the U.S. you have a more developed, more sophisticated banking market than the one you just described, and one where lenders really do understand increasingly over the last 20 years the value and security of lending against recurring cash flow streams, exactly. Not just hard assets. And so I think the best capital allocators are active but prudent users of leverage, particularly in businesses that have very predictable cash flows. There are a number of examples in the book of CEOs whose businesses had those types of cash flows and who, were very successful in optimizing the use of leverage around them.
Yeah, I often talk about like the structural environment in terms of what creditors are willing to provide you, what the capital markets are like, which also affect the behavior of the CEO. Because if you have a bank that's like kind of like slapping your hand and saying you can't do this, or if they're saying, okay, if you do this, I'll give you this, it really does have an impact on the company. Because even if it was a fantastic operating business generating tons of reoccurring cash flows, and if they're just saying, hey, we need to buy another factory because we're trying to achieve growth and we can't do it unless we buy the land, they're kind of handicapped in a sense, Will. And I think that many people do not talk about that in terms of how they analyze companies, because the whole argument about many of the companies in Asia is it's the parent company and then there's gazillion subsidiaries, and they're all doing non-core businesses, and it's extremely frustrating from an investor's perspective on why the company is structured the way that it is. But it's what the central banks of those countries are kind of like dictating to them. So, I wanted to share that to you in terms of an observation for the markets here. But overall,
yeah, that's interesting.
I hope maybe we can talk about them sometime in the future as well, because it affects how people should be looking at companies and investing in them. And sometimes what happens in less developed markets is they argue that, well, the CEO has a fantastic track record and that, he's doing something that is relatively nationalistic to go out and buy a 1% equity stake in a football club, for example. But frankly, it's just absolutely ridiculous. And I'm actually trying to communicate that to Asian investors of capital markets, or even multinational institutional investors into some of these companies, just to say, hey, no, it doesn't have to be like that. And I genuinely believe there's an arbitrage that exists, because if you can source the creditor to these foreign companies, then they don't have to be the way that they are. So I think that's a fantastic whole new market that no one's really addressing properly. You have some private equity guys, you have some, fund management companies, but I genuinely believe that it's still not being addressed sufficiently.
Yeah, I think that's right. I think you want a CEO who is going to look rationally at the capital markets and take advantage of dislocations and opportunities. So if debt is cheap and compelling and attractive, they'd look to take advantage of that. And if equity is similarly cheap, maybe they look at that, or if they have an opportunity to repurchase. You want someone who's rational and opportunistic,
right.
and flexible.
Sometimes it's hard though, Will, with like the states as well playing a big role. If you look at a company like Gazprom, you'll say, well, they have their dividends is attractive, their valuation is attractive, but who's the CEO? Is it Vladimir Putin, or is it the actual CEO of the company in a situation?
No, that's right. That's right. Every case is different. And Gazprom is a very complicated, scary situation. Yeah.
Well, thank you, Will, for your time. I'm hopefully sometime later in this year we can come back and take a review on how some of these CEOs that you mentioned are doing.
Thank you, Peter. Take care.
Take care. Bye.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.